It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome back, Managing Your Financial Future. Johnny Dean, your podcast host here, and Professor Rick Plum, our certified financial planner professional, and the advisor portion. Hello, Rick.
Good morning, good afternoon, good evening.
We did show 100 last week. I did check. It was show number 100.
So we counted correctly. You know, we had enough fingers and toes to get that high.
Right. So now we're on our way to show number 200, and I don't know what's going to happen between now and then. There's nothing really to celebrate on show number 101. Other than to say we're going to continue giving you the best quality information and that we possibly can. How's that?
Sounds reasonable to me.
I'm not promising it's going to be the best in the world because I can't do that, but we don't know what we're going to say from show to show. You might have noticed that we've been talking quite a bit about things like income, things like buckets, and why. Why is that? Well, Professor Plum, again, not to keep harping on the markets, but I mean...
They haven't been pretty lately, have they?
No, and it astounds me how people's sentiment changes at the drop of a hat.
Well, as soon as you start seeing some negative numbers, the attitude, the once aggressive, I can handle, this type of investment, person changes. We were really excited to be investors last year when the market was hitting all-time highs.
Oh, yeah.
And then now that it's on sale, it's down 20, whatever.
We want to flee.
It's like, oh my gosh, I can't be an investor now. This is the time. This is a much better time to be an investor than it was 6-8 months ago.
Oh, isn't it though?
But on the other side, as an investor, by definition, you have a long-term time horizon. Otherwise, if you have a short-term time horizon and you're playing in this world, you're a speculator, you're a gambler. An investor has a long-term time horizon. As an investor, we have a long-term perspective. The short-term fluctuations of the stock market are not as big of a deal to us as the long-term outcome of the market. And so far, historically, the long-term, 10 years or more, have produced reasonable results. Sometimes very reasonable, sometimes mediocre. But it's that time horizon that gives us the thing. So whether you're an investor 6 months ago or now, you should have the same sentiment. This is long-term money, and I like the fact that I'm getting it a little cheaper. But when it comes to what my overall return will be 10, 15, 20 years from now, the difference between June, January, March, and now isn't going to make that much of a difference.
No, and this is just doing what markets do. And actually, I think what it's doing is it's shaking out all the short-term people because those are the people who got scared and they're jumping out.
And they lost their shorts.
I mean, that's right. If anybody should be jumping in, it's everybody.
But that's why we do bucket strategy. For somebody who's looking to retire, and people will be like, well, I'm going to retire next year, or if I'm retired now, I don't have 15 or 20 years. Well, yes, you do. For some of the money, you're 65 years old, 70 years old. 10, 15 years is not that much of a stretch given today's longevity. And so most likely you are going to be here when you're 80, even 85. And so you need to send some money ahead for that period of time. But you don't have to be totally safe with it today because you're not spending it today.
Right.
On the other hand, you are spending some money today. And so that money you want to be safe with so that if you need to spend $1, you've got $1 this week, next week.
And that's what we've been talking about over the last few weeks. And so while I'm not going to keep hammering on that point, although it's an excellent point and it's why, Professor Plum, you do a bucket strategy, I want to talk about, we've talked about setting up bucket number 1 before, but I want to talk about something that we call the spending order. When many people retire, let's put it that way, they have different types of accounts.
Yes.
They may have a 401k from their work or 403b. They have some kind of work retirement plan.
A tax-deferred retirement account.
In some cases, they might have an IRA, a traditional IRA.
Again, tax-deferred retirement account.
Correct. So, money that they've put aside there. And maybe they have a Roth IRA.
Maybe, yeah.
Potentially, which is a different tax treatment. And many of them also have some kind of personal money.
Right. Either they built some personal money along with their savings. That's not the most common. Or they inherited some money
Sure.
They're either at retirement, just before, or a little bit after retirement. So they end up having these three different pools of money that have three different systems of taxation.
In other words, the pre-tax, which is the Roth, which is the 401k
right,
type,
the IRA, traditional
and
IRA.
the traditional IRA. You have the tax-free, if you want to call it that, in the Roth side.
Right.
And then you have the what they call taxable, but at different levels.
Right. And with the personal account, the non-sheltered accounts.
Maybe you have it in a brokerage account.
A brokerage account or bank accounts where, regardless of whether you spend it or don't spend it, or whatever is actually earned in that account, and that's what they call realized, is taxable to you in that year. We saw this a lot last year where people got surprises from their mutual funds that they had personally, where they held on to them. They were going well, and the mutual funds had fairly large distributions at the end of last year. And they're like, wait a minute, I didn't sell anything. I didn't get any cash, but I got this tax bill. And it happens. I mean, if the mutual fund has a capital gain distribution, you get to pay tax on it.
Yeah, so there are different pools of money, different accounts of money that people often retire with that have different tax treatments when you take money out of them. The question that often comes up, or should come up, is, well, I've got these different pools of money. I'm going to set up some kind of bucket strategy where I'm taking an income. Professor, how do you decide let's say when you're setting up your bucket number one, how do you decide whether you fill that with
IRA
or
Roth
401k,
IRA,
Roth IRA,
or just spend my own bank account?
So you mentioned last time in the last show we gave that example of somebody with $1 million, easy math, and we said, okay, well maybe we'll set aside $300,000 for bucket one. We're just picking a number here, $300,000.
Right.
Now you need to fill that with something, okay? And I've got 401ks, traditional IRAs, Roths, and brokerage account.
We've identified the type of investment that it's going to be in. It's going to be in something that's fairly secure or very secure. Not going to have a huge amount of earnings with it because it's so safe and liquid. So we know the type of investment, but what account do we use to buy that investment? Do we use our personal account? Do we use our IRA, or do we use our Roth IRA? Understanding the taxability of those issues. If I put that $300,000 into a cash account right now, maybe I'm earning 2%. What's that? $6,000 a year. I may be taking $40,000 a year out of it, but only $6,000 in the first year and less as we go along is going to be taxable. So my cash flow and my taxability are completely different. And so that's one way to keep my taxes really low, is by taking it from that type of an account.
Like a cash account, you're saying.
Or something of that, laddered CDs or
money
something
markets,
like that.
whatever.
But if I did that same exact investment inside my IRA, and I took my $40,000, $50,000 out of the IRA, that whole $40,000, $50,000 is going to be taxable to me.
When you say IRA, it could also mean 401k.
Tax-deferred retirement
Some kind
account.
of tax-deferred.
I'm going to use IRA as an overall.
That's a catch-all phrase for pre-tax
403B,
money.
457, profit-sharing plan, those kinds of.
Right.
And the reality is many people will roll those to an IRA when they retire anyway. So
potentially, if
we're going to call them
if
IRAs.
it suits them, yes.
Right. So I've got a different taxability. I've got the exact same cash flow. I'm still getting my, let's call it $40,000 a year of distribution from the account that I'm putting into my checking account and spending. But if I'm using personal money, a lot of that is the principal that's coming out that I don't have to pay tax on because it's already been taxed. And I'm only paying tax on the earnings on it annually. That's the personal account. Or if I take it out of my IRA, I'm going to be pulling out an IRA distribution, which is, for most people, 100% taxable. Same cash flow, very different tax treatment. And then on the other side, if I have a big enough Roth, maybe I could use my Roth IRA, and assuming it's a qualified distribution, it's been more than 5 years, yada, 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 59 and a half or more, that cash flow is 100% tax-free. Doesn't affect anything. Doesn't show up on my tax return in the taxable column. So how should I be setting up my bucket number one? And by extension, what do I then put in bucket number two and bucket number three down the line?
Well, yes, and that is the question, because when you first set up your buckets, you've got to determine where this money is coming from. And if I take it all out of my, as you said, if I take it all out of my IRA, it's going to be 100% taxable. Is that the right thing to do?
And not only is that going to be taxable, but this becomes one of the more confusing areas of tax law. If I'm retired and I'm receiving my Social Security, And now I have a decision. So I've got my Social Security. Between my spouse and I, we've got, call it $40,000 a year in Social Security. Just purely making it up. I mean, it's a good size Social Security, but it's $40,000. So if I'm taking an additional $40,000 from my portfolio, how is that going to affect the taxability or non-taxability of my Social Security? If the only thing I have is $40,000 of Social Security, my Social Security is not taxable.
That's just how the tax code is set up.
Right. And if I have $300,000 of personal money and $700,000 of IRA, and I put the $300,000 in the safe account that's earning 2 or 2%, call it, and I'm getting $6,000 of interest from that. That's $6,000 of interest, even though I'm taking $40,000 a year of cash flow out of it. That $6,000 of interest is not enough to affect the taxability of my Social Security. So I'm still not paying any taxes. But that's only going to last for a little while because I said I only had $300,000. So when that first bucket runs out, then 100% of the money is going to be coming from the IRA. On the other hand, if I start taking $40,000 a year out of my IRA, that's definitely going to leave a mark on my Social Security.
You better believe it.
It's going to have a big source of taxability. A big chunk of my Social Security is going to become taxable. And so where I might be in the 10 or 12%, what you would call the 10 or 12% income tax bracket, my taxes went up by a lot more than 10 or 12% by taking that $4,000.
Because a portion,
now a big chunk of my Social Security is taxable as well.
Yeah, which you hadn't counted on.
Which I didn't expect or think about. So what is the best way to do this? Now, not everybody's going to be in that game. Some people already have $50,000 of pension, $40,000 of Social Security, and they're taking another $40,000 from the portfolio. Now, their Social Security is already taxable. So now we're looking at a different game. But it's a matter of how do we make the best use of the assets on hand and the types of accounts that we have to manage our tax bill. I mentioned that if we take it all from personal money, we're in a very low tax bracket right now. But 6, 7, 8 years from now, when the bucket number 1 runs out, I'm going to be in a much higher tax bracket.
Why is that? Explain why that is.
Because in my example that I said, I don't have any personal money left.
You've spent it all in bucket number 1, so all you've got left is taxable money coming out of your IRA.
Taxable money is the only thing so it's going to be taxable. What happens also if you got a married couple, at some point, that surviving spouse, and unfortunately it does happen, we die and we leave a surviving spouse, or we are the surviving spouse, whichever it goes. That tax bracket changes dramatically for that because now they're a single taxpayer and their brackets, even though we still have the 10, 12, 22, 24,
they've been cut
the
in
amount
half.
of money that you can have and show in the bracket goes down. You jump brackets really quickly for that survivor.
Right.
So when we're designing the location, when we first do the bucket strategy, it's to determine the allocation. What assets, what types of assets should we be considering for different uses? Now we've determined how much money we need in the safe accounts, midterm accounts, long-term accounts. Now it's a matter of which accounts should we be using to buy those assets. And this is what we call asset location. First one is allocation, then it's location. One is to manage risk and return and systematic distributions. One is to manage expense, taxes. And taxes are one of the bigger expenses that we run into when we're unfortunately or fortunately managing an actual investment portfolio. So how do we go about doing it? We have to take a look at where we are today and where we're going to be in the future. And the other thing is, if I'm retiring at 65, I have 7 years before I have to start taking money out of my IRA.
Well, that plays a big role. The required minimum distributions, which currently began at age 72.
So even if my mix was more of a 50-50, or I had a decent-sized personal account and I could live on it for a little while, and I just didn't want to take any money out of the IRA, so I could keep myself in a 0% bracket for a while. When the RMD kicks in, if I just leave my IRA grow for another 7 years, it's going to be that much bigger. I mean, it could be 70, 80%, 100% bigger than it is today. Then I have an RMD, and now I'm really going to be in a tax situation because now that's going to affect my Social Security as well.
Why do I keep seeing online and reading that
you go to the news source that everybody should trust?
Yeah. You should You should always, they say, never pay tax, never take money out of your
IRA until you're required to.
Because why pay taxes now? You can skate by taking money out of your personal accounts or your Roths. Use those first, and only until you hit required minimum distribution age should you be taking money out of your IRAs.
Because
why do I hear that, and why is that? Why is that potentially not good advice?
You're hearing it because you're talking to somebody who probably has never done a tax return, who doesn't understand taxes and just figures, well, why it's going to be taxable the same either way. It may or may not be taxable the same either way.
Yeah.
So in that first example where we're taking 40,000 out, I'm not necessarily advocating that you take all 40 from the IRA in addition to your Social Security, but maybe take 20 of it from the IRA, slow the growth of the IRA, start looking to the required minimum distributions so that it's into your planning already, and blend the buckets, what we call it, takes some money from IRA and some money, and still stay in a 0% bracket. And then stay in it, and because you've used some of your IRA over the next several years, stay in a lower bracket so that you don't have as big of an RMD, which won't affect your Social Security as much. It's a very interesting interactive game. We have an ability to take a certain amount of money out of to show a certain amount of money on our tax return and not pay any taxes. And so what we call the 0% tax bracket.
There really isn't there isn't an official 0% tax bracket.
No, the tax brackets start at 10%. But they're talking about the 10% is the first tax bracket that we hit, and that's on the first X amount of dollars of taxable income that our tax return shows. But not all the income that goes on our tax return is actually taxable. We have a standard deduction or an itemized deduction, whichever one is bigger. And so the amount equal to those deductions don't get taxed at all.
Let's leave itemized alone. I'm going to get too technical on the tax thing here. But if we leave itemized alone, everybody has a standard deduction.
Right. It's different whether you're single or married or
right.
head
So
of household.
let's take a married couple. There, I think it's $25,900.
Very good.
Is that what it is?
Yeah.
Of standard deduction.
Right.
So
the first $25,900 of your total income that shows up on your tax return in the taxable column doesn't count.
So I can make 25 as a married couple, we can make $25,900. If I had no other income, I could take $25,900 out of my.
And that's if you're not even 65. It goes up more if
it
you're
does.
65.
It goes another $1,400 per person or something. It's a little higher than that. It's 20. What is it?
That's $1,400 person.
Okay, $1,400. Wow,
So
I'm hitting the numbers.
You are on it.
I am. Okay, so but if I had no other income, I could take money out of my fully taxable 401k and
not pay tax.
Not pay taxes as long as I stop at $25,900.
And plus $1,400 each for you and your spouse if you're 65 or older.
Right. Is that correct?
That is correct.
So money that should be 100% taxable. What you're saying, if I'm hearing you correctly, is if you're in a situation where that happens, take advantage of it. Is that what you're saying?
Definitely take advantage of it.
Why would you take personal money out or Roth money?
Why would I spend, in my example, taking $40,000 a year out of my personal account when it's not very much taxable, when I could be taking some of that out of the IRA and not paying any taxes? Leave my personal money for later on when I do need that tax savings. But it all comes from an understanding of the tax codes and how taxes work. And the really hard part, though, is when Social Security gets moved into the game. And I have yet to see an article that actually explains the taxability of Social Security correctly. I mean, other than the IRS websites or tax program at websites, it's complicated. And I think that's why I don't read about it, because most people don't care about the weeds. They don't want to. They just want to know the basics, which is fine.
Let me ask you this: let's throw Social Security into this mix. Let's say between my spouse and me, we're making $25,000 of Social Security. That's our Social Security. Does this mean I only have $1,000 of room left? Or $900? I'm sorry, $900 of room left of tax free.
Before you get to the standard deduction, you have to find out how much, if any, of that $25,000 of your Social Security shows up in the taxable column. Remember, it's the items in the taxable column that we add all the way up, and then we reduce that number by the standard deduction. So if the only thing you have is $25,000 of Social Security, going through that formula first says none of your Social Security is in the taxable column.
So none of that counts
not counting at all
toward my $25,900 of tax free, right?
For a married couple, you'd have to take out about $20,000 of your IRA before $1, and this is round numbers, don't hold me to the exact, but you get $20,000 of regular IRA distribution, you get your $25,000 of Social Security, the next $1 or next $2, maybe $1 of your Social Security becomes taxable. So if you take $32,000, $12,000 over that, $6,000 of your Social Security shows up in the taxable column. And then you can reduce it by the $25,000 standard deduction. This is complicated. And I know.
Everybody follow that who is listening?
But it's a sliding scale.
Of course it is.
And that's the problem with the taxability of, one of the problems with taxability of Social Security, other than the fact that it starts too low. I mean, it was set in 1983 and hasn't ever been adjusted since then. But it's a sliding scale. And so being in the taxability of Social Security may not be the worst thing. You may want to pay a little bit of tax on your Social Security to avoid paying a lot of taxes on your Social Security later on. Because it starts off at a $1 of Social Security for every $2 over the threshold of income for a little while. And then after that, it goes to 85 cents for every dollar. So it goes up quicker. And so it escalates very quickly.
All right. But if I have $25,000 of Social Security between me and my wife, I can still, just based on the way the tax code works, I can still take about $20,000 or so out of my IRA, which is fully taxable, but I can pay no tax on that and still. So now I've got about $45,000 between Social Security and my IRA. I could make and pay no tax on that. Am I correct?
Correct.
That's how the tax
Those
code
are roundabout
works.
numbers. But
I understand, yes. But roughly,
you can probably get a little
amount.
bit more than that, but yeah.
But roughly that amount.
And then after that, then you're going to start ramping up a little bit.
Okay, but let's say, so now, I've got $25,000 in my example I'm taking of Social Security. Now I've taken another roughly 20, let's call it 20 out of my IRA.
Yeah.
Okay, I've got $45,000 of income, let's say. Okay, I need another $25,000. I read somewhere that there is a 0% capital gains tax bracket that goes almost exactly through the
12% ordinary income tax bracket.
So if I need another 20,000, can I get more money tax free? In other words, at this point, is there a way to do that using a 0% capital gains tax bracket?
Yes and no. In this example, if I sold $50,000 worth of stock and had a $20,000 gain on that stock, I would pay zero tax on the gain. But that $20,000 of gain does go onto my tax return into that very first calculation, and it would subject a big chunk of my Social Security to taxation. So it is true that I would not pay any taxes on the gain itself.
But my
Social Security would show up taxable.
Some portion of that Social Security.
In our example, a good portion of it. So, but it and all these things are interactive. They interact with each other.
Sure.
And so you have to understand how it's working. And that's part of the problem of tax planning, because in a year like last year, where we thought we were keeping our incomes in a certain level, and then all of a sudden we got a huge capital gain distribution from our mutual funds, it threw our numbers out of whack. And I see this a lot for people under age 65 who are trying to keep their income at a certain level so they get their medical insurance subsidy from the ACA.
Sure.
And then all of a sudden, boom, at the end of the year, they went way over because of a capital gain distribution, and they had to pay back the subsidy at the beginning.
Of course. Oh, sure.
That hurts.
I don't know if it was Morningstar had said at some point that you're generally more tax efficient if you spend your taxable money first, then your pre-tax, then you're tax-free. Have you heard that?
I've heard it, but I don't necessarily agree with it.
Yeah.
Now, I do think that it can give you some flexibility in your planning. So if I was doing it this way and I had a decent-sized personal portfolio, and maybe I'm 50-50 between personal and traditional, and I'm looking at that thing, well, I want to make this as easy as possible on me. I don't want to be caught off guard by a large capital gain distribution at the end of the year. And so obviously if I'm taking money out of my IRA and I'm working my numbers right to the, pretty close to the limit, and then I get an unexpected, tax windfall at the end of the year, capital gain distribution, it could throw my numbers out of whack. So one of the things you could do is take the distribution from the personal account, and then at the end of the year, one of the things you said earlier is very important. Don't waste the 0% bracket. Use that 0% bracket. Use the tax code to your favor. Find out where you are, how much room you have in that supposed or that so-called 0% bracket, and convert from traditional IRA to Roth IRA. Maybe you do a $20,000 conversion, $30,000 conversion, and it shows up on your tax return, but because of the standard deduction and everything that goes on, you still owe no taxes. Now you've taken you're using your IRA not for current spending, but you're transitioning it from a taxable environment that if you just let it go until the required minimum distributions hit, it'll probably be a much bigger number, and you may have to pay some taxes at the point. Let's use that lower tax bracket now, whether it's the 0%, 10, 12, depending on where you're at. Sometimes we see very efficient Roth conversions being done in the 22% bracket.
Wow.
Because if they don't do it in the 22% bracket, they're doing $100,000 conversions or more because they've got $1 million IRAs, but their RMDs are going to just bite them in the future. So, but we have to look at where you are, where you're expected to be, and what these numbers look like. The other thing we have to pay attention to is if you don't want to get too crazy on the income and say, well, I just want to do it all in 1 year, 2 years, 3 years, and take it up to the 37% for 1 year, because it's not just 37%. Because now, if you're on Medicare, you get to pay that higher income tax bracket, and you get to pay a higher Medicare premium.
Which is what, another 3%?
No, that's the net investment income tax.
Oh,
I'm talking
sorry.
about IRMA.
IRMA. Well, no, IRMA, yeah. And how much more is that? That's the income-related monthly adjustment amount.
Yeah, and it
could
be
triple
$6,000-$7,000 a year.
It could go from
each.
$150 a person or whatever it is now, take you up to what, about $500?
Give or take, yeah. A person.
Potentially per person, yeah.
Well, but at least if you're paying that much more premiums, you're getting a better insurance.
Well,
wait a minute, no, you're not.
Every time you take money out of a taxable account, 401k, Roth, capital gains, it could potentially hurt. It will have an effect. It could potentially have an effect somewhere. Is that correct?
Not the Roth.
No, I don't. No, I'm not
you
saying the
mentioned
Roth.
But I'm just Roth is off the table.
No, I'm not saying Roth. I'm saying your anytime you take it out of your taxable account,
right?
Or your
anytime you earn interest in your personal taxable account, anytime you have a realized capital gain, a dividend,
yes,
any kind of income that's created in your personal account, or any distribution from any of your tax deferred accounts, is going to have an impact on something. And so the idea is to be able to manage that impact to lessen the severity by using it to your advantage. But first, to be able to use it to your advantage, you have to actually know how it works.
Well, even if you don't, you can talk to Professor Plum here.
Or any of the advisors here.
That's right, at Lucia Capital Group. Well, this is the kind of stuff that you guys do all the time. The idea of not wasting your 0% tax bracket.
Or your low bracket.
Maybe you can take advantage of.
And for some people, the 22 is the low bracket.
But for many people, it probably isn't. The 10%, 12, whatever.
12 is probably where people retirees are going to be playing.
Yeah. So
but
even
if you've got Social Security, it's not a true 12 anymore.
Social Security, while it can provide a wonderful basis.
Oh, it's great.
It potentially, because Social Security can be taxable when you add up other income, which it could be from your IRAs or whatever else, or if you have a job. If you're after full retirement age, whatever it is.
If you have income from any other source.
Your Social Security could subject itself to taxation.
Yeah.
But what you're saying is, do not waste that, under any circumstances, do not waste that 0% tax bracket.
Do not waste good. And good is relative to based on the amount of money you're taking. 0% is for some people. Some people don't have the option with that so-called 0% because they have a pension for $30,000, $40,000. And they're never going to be a 0% bracket.
Yeah.
Oh, well, so 12 may be a good thing. 22 may be a good thing. Anything less than, what you're going to pay later is better than paying it later.
When you say later, that's because if you have an IRA that's growing, tax deferred, by the time you hit age 72, you are going to be required at that point to take, I think it starts at roughly 4%.
A little under, but just under.
Yeah, 3.6
or something. But it's gone down a little bit, thankfully. We've got some new tables for
Well,
RMDs.
that's true. All right, we'll call it 3.5, whatever it is. But you're going to have to take out $3,500 for every $100,000 that you of value that you have in that. So this is where when you're starting to be required to take money out of those taxable accounts, you have no choice at that point.
It is a required minimum distribution, and the penalty for not doing what's required makes the required minimum distribution look very pleasant.
Well, that's true. I mean, there are people with $1 million IRA,
Multi-million dollars IRAs.
Even one will cost them. They have to take out 35,000, 36, 38, whatever it is.
Call it 40. We'll just go with the 4.
Well, I will say
Their
$40,000.
penalty is $20,000.
$20,000.
And you still have to take the money out of the IRA at some point and pay tax on it.
Yeah, it does no good to miss that. But that's where people get stung when they hit age 72. And not only is that 0% tax bracket gone, but depending on what other income they have, I mean, the 12 could be gone. The Social Security could be in full taxation. Yeah. Who knows, right?
And it's a matter of, people, they say, don't touch your IRA until you have to. Well, if you retired at 60, 62, by the time you take your IRA, it could be double or more than double than what it was to begin with.
So going back to this whole idea of buckets and setting up your bucket number one, which we talked about here at the beginning of this podcast, how do you know whether to fill it first with IRA money or personal or Roth or whatever?
Well, you have to look at the rest of the plan, the rest of the strategy. Is your strategy to take, are you already taking your Social Security now? And so how is the distribution going to affect that? Are you planning on deferring taking your Social Security until a later age? That gives you a little bit cleaner of a tax bracket and a little bit easier to understand what the true taxation is going to be. Mm-hmm. And so it's all a matter of what does your financial life look like, and how do we, if possible, do something that makes it as efficient as possible. You're looking at what is happening today, but you're also looking at the future. What is going to happen if I don't take any IRA money out now when I hit RMD age? What is going to happen further down, hopefully a long time in the future, when there's only one of us, if we're a married couple? How is that going to affect us?
Oh, man.
So how do we make this work in basically those three stages of our life? How do we make it? And what is it going to look like? Now, the problem with that is we have no idea what the tax code is going to look like 5-10 years from now, let alone 15-20 years from now. Is the current 10, 12, 22 going to sunset and go back to the...
Well, it is supposed to, is it not?
Yeah, in sunset,
2025 or the end of 25?
Yeah, somewhere in there. So not too far from now, where we go back to the 15, 28%, 15, 25, 28 instead of the 12, 22, 24. Yeah. So that's a tax increase right there. We'll see what else happens. Now, we're trying to project into the future with a sort of an unknown. But I do know people that have done some very large conversions because they feel the taxes are going to go up, and they might as well do it while they know it.
So they don't mind paying 28 or 32 or whatever it is right now?
Because they've got very large IRAs, and they're postponing taking their Social Security. And so by the time they get to 70, they have a very large Roth IRA and Social Security, and they're going to live tax-free and have quite a bit of cash flow.
Well, would you say that's a good goal to have, as to by the time you reach age 72...
I don't know if going all the way to zero on the traditional IRA is necessary. The one person I was thinking of was going to do that, because if I've got $100,000 in my IRA, even $200,000, and I have a required minimum distribution of $4,000 or $8,000, it's really not affecting my Social Security or other things if the rest of my money is coming from Roth IRA.
I don't necessarily mean taking it all and dumping it and getting the taxes out of the way. I mean, I guess you could.
It's a lot of the financial planning that we talk about is not just dollars and cents, it's emotions. And sometimes doing a conversion, even though you have to pay the tax now, and it makes you feel really good. And on the other hand, doing the conversion sucks when you have to write that check. It's all about the person who's doing it. I've seen it both ways.
Roths really changed planning in many ways.
Made it a little more complicated.
Well, they made it. They
better.
Gave it better. They made it better. They made it more complicated, but they gave you more options, I think.
Oh, yes, definitely.
And ideally, would you say, the less money you have at age 72 in your IRA, and the more money you have in a Roth.
In a perfect world, I would find some way to get a deduction while I was putting it away, and then have it completely tax-free in a Roth IRA when I was retired. But it doesn't. It's a trade-off. Which do I value more? The deduction when I was talking to somebody and their daughter just yesterday. 26-year-old daughter got a new job, new 401k. They have the option of traditional 401k or a Roth 401k. They're making a good income, and for a single individual making close to six figures, They're in the 22% bracket, plus the state that they live in is pretty high. And so long term, the dad and I were talking, and he's like, I think she should be doing Roth IRA because long term is going to be the best thing. I said, yeah, but the pain of doing the Roth IRA right now may make her not want to do it. And she may like to have the idea. And she may be able to, in her mind, afford to put, let's say she wanted to put $1,000 a month away. Well, if I'm putting it into a Roth, I see my income go down by $1,000 a month. If I'm putting it into the traditional 401k, I see my paycheck go down by about $665 a month. So I'm saving $1,000, but it only feels like $665. So if I really was okay with $1,000, maybe I could save $1,500. And it's, I'm putting $1,500 away right now in my 401k, but it's only costing me, in my mind, my paycheck, $1,000 a month, which is the same as the Roth. So,
oh man.
So which one is better? It's whatever, as long as she's saving. I mean, God, that's incredible. As long as she's saving, it's whatever makes her feel better about doing it and building that portfolio.
Sure.
And knowing this particular situation, she's in her mid-20s making pretty good income. She's probably going to do very well over time. And so I was kind of pushing towards Roth, but I fell back on the old 50-50.
You can better be 50%, right?
Do half of it Roth and half of it traditional.
You would hope so. This is all about strategy. This is all about planning. This is all about understanding tax brackets, which can be very confusing. I mean, we tried to explain this here.
It's hard to do it over the air.
Listening.
It's hard to explain taxes sitting in front of somebody, paper and pencil, and showing them how it works.
Yeah.
So doing it over the air is very difficult. But unfortunately, it is a necessary evil.
Well, it is. But as you showed, taking advantage of things like a 0% tax bracket is one of the ways that you can potentially control the amount of money that you're paying and potentially minimize it, I would say.
Trying to manage it as efficiently as possible and minimizing it, not just necessarily for today, because you could, in the examples we were doing before, you could run it to zero by just using the personal money we were talking about in our examples. But that isn't managing it appropriately, because that means you're not using the brackets to your favor. You're leaving something on the table. And when it comes to leaving this, that means it's going to cost you more in taxes later on. It's one thing if our vacations cost us a little more, we're still having fun.
Yeah.
But paying taxes is not something most of us enjoy doing.
Well, what it comes down to is if you've got X number of dollars available of income that are going to be in a 0% tax bracket, find the source that would have charged you the most taxes under ordinary circumstances and
get the
use
biggest
that
benefit for it.
Get that. To me, there are few tax strategies better than that.
Right. Using taxes. I mean, what is it? Death and taxes. The only two things that are guaranteed in life.
Right.
But there are, in some cases, not everybody has the option to manage their taxes. Some people are just, they've got too much income guaranteed, and there's just nothing they can do about it. But if you're in a position where you can we've talked about spending the bracket in previous podcasts, meaning spend up to the top of the 12% bracket. Instead of once I've maxed out my Social Security, let me take it all the way to the top of the 12 and reduce the IRA into the Roth as best I can. Don't give up. Don't waste good.
Well, think of it this way: if I have $20,000 left of room in the so-called 0% tax bracket, and I can take 20 out of my Roth, or I could take 20 out of my IRA, and that's my choice.
I'm taking it out of the IRA.
Why would I waste? I get the Roth money tax-free, assuming I'm 59 and a half and all that. Yeah, take it out of the IRA. It's going to be tax-free.
Well, and it doesn't just go to this type of tax planning. It goes to end-of-life tax planning as well. I was speaking with somebody a week or two ago. They had about $2 million in their accounts, and they were going to leave half of it to charity and half of it to their one child. And I said, well, you're leaving the IRA to the kid. Yeah, we want him to get $1 million or whatever the number was. But you're leaving your personal portfolio to the charity. We want the charity to get $1 million. Let's switch that. Switch the beneficiary.
Yeah.
Give the IRA to the charity. They're still getting $1 million, right? Give your personal account to the kid. Still getting $1 million, right? But they're getting $1 million without taxes.
That's exactly right.
You give $1 million IRA to a child, or anybody, a person, they're going to have to pay taxes on it. And now we have got the new RMD rules. They'll have to pay it over the first 10 years. Give it to a charity. they get the whole million.
They don't pay taxes on it. Even if they did, let them.
And under current law, you give a $1 million stock portfolio to a descendant, an heir. There's no tax on that. We're talking about income tax at this point.
Yeah.
And at $1 million, there's no estate tax either. But they get it. They get to use all $1 million of it. They don't have any reduction to taxes.
We could go on and on about
tax planning matters.
It does matter, and you want to talk to Professor Plum or any of the Lucia Capital Group advisors about your tax planning. Give them a call, 800-644-1150, the number at Lucia Capital Group. You need to manage your taxes in an effective way. There's a difference between minimizing your taxes on the short term and managing them for the long term. Professor, I think you would agree, managing your taxes for the long term is far better, correct?
Oh, yes. You'll pay less in taxes overall rather than saving it for a few. It's pay me now, pay me later type thing.
Yeah, right. Which I always forget. Fram or Pennzoil?
Fram oil filters, I believe.
I think that's what it was. Yes. So talk to any of the Lucia Capital Group advisors, 800-644-1150. Find us online at luciacap.com, where you can get a lot of this information via videos and blogs and other podcasts. Listen to those. And speaking of podcasts, go to Spotify. You can subscribe to our podcast on Spotify and catch all of our previous 100 episodes. Thank you so much, Professor Plum. This has been
very welcome.
Remarkably educational.
And you know the weird thing about this? I like this stuff.
Well, I think after having listened to this, people should think, I kind of like it too.
Knowing how this works and how to use it to my advantage is wonderful.
Isn't it, though? 800-644-1150. My thanks to Professor Rick Plum, Certified Financial Planner Professional. For him, I'm your podcast host, Johnny Dean. Thanks so much again for listening. We will talk to you next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.